Okay, we're live with Sam and Kevin today. So excited to have Sam back on. Kevin, as always, excited to have Kevin on. Kevin actually wrote an article today on copper. So we're going to talk about some fun stuff today. Copper, talk about the grains, taking a little hit this morning. So let's look at the performance just today. Rough Rice is leading the way. Haven't seen Rough Rice on top in a while. It's something that's very, very untradeable. Somebody asked me like the ticker for Rough Rice the other day, and they were like upset I couldn't figure out. I was like, I can't even remember. I haven't traded it in fucking 10 years, I think. But
Yeah.
it's a very like liquid product. You don't want to really trade it for the most part. So I would stay away from Rough Rice unless you're just trading it one contract at a time. Coffee right behind that up 1.8%. Natural gas behind that up 1.5%. The Russell 2000 is leading the indices today. That's quite interesting, up just over 1% still. Lean hogs right behind that. And if we look at 1 month performance, soybean oil leading the way. Very cool to see that. Once again, we got a breakout signal a couple weeks ago now. It's just trending at the moment, but once again, there's a lot of reasons for that. We'll get into that a little bit later. Palladium right behind that, up 10%. Kevin talked about a nice bounce where he thought we would see in palladium. Absolutely saw that bounce, so great call from Kevin. Crude oil up 10%. Something we talked about a lot on here is oil, so we'll get into a little bit more of that today. Heating oil up almost 9.5% today. Gasoline up, in a month. Gasoline up 8% in a month. So a lot of these, the energy sector is really doing pretty well. It's very interesting to see. And copper is finally starting to catch up a little bit, catching a little bit of a bid last week. So if we look at the 1 week performance, you see that copper's up 5%. So Kevin, you wrote an article on copper recently. So what are you seeing in the copper space, the industrial metal space in general? Your Kevin's article is called Copper Mini Short Squeeze Amongst Bearish Fundamentals. So I'm going to post that into our chat.
Yeah. Nothing like a little bit of a Saturday afternoon article to write while you're barbecuing. So, I had a lot of questions hitting my DMs on Twitter or X, whatever you want to call it, around copper, because it was we had a lot of economic data last week that just didn't provide that bullish case, especially when you're looking at the industrial side of the market or the manufacturing side of the market, not only here in the United States, but also when you're looking at the East Asia markets, China, and then also when you're looking at the European Union in some respects. So we did see a nice little bid in copper last week, up about 6.7% for the week, which was a very strong move, right? When you're looking at it. So what was the reason for the bounce? There's a couple of reasons for the bounce, but the main reason is a short covering that took place. So there's a lot of short sellers that were in this market. They were trying to really buy back their contracts, especially when you're looking at the near dated futures contracts, because they don't want those contracts to be deliverable, right? So just to give a little bit of a high level overview, because a lot of people are very familiar with equity options. And futures, in a sense, kind of operate the same way, but there's a key difference, right? An equity option, when you buy a contract, you have the right to exercise, no matter if you have a call or if you have a put. Futures is a little different, though. The seller has the right. So when we have this first notice day scenario coming up, first notice day basically means that's the first day that sellers could go out that actually hold the contract and say, look, I'm going to exercise this and I'm going to deliver the physical commodity to whoever that buyer is. And so just like with equity options, you get to sign that, then you got to kind of figure out the logistics, right? Now, I would say 90%, 95% of all physical contracts are not delivered at all. Futures markets are made for hedging. But these short sellers were trying to get out, and so they were buying back their positions because they are concerned that they're not able to obtain the physical product. And so a lot of these managed money players, they don't deal with the physical commodity. So that was one of the big things there. The other thing that actually did take place too, and the reason why we saw this catalyst, is that there was expected deliveries over the last 2 weeks for copper to hit the United States that has not shown up. I don't know why they have not shown up, but they haven't. So that's also another reason for a concern for those short sellers. If they saw some physical supply coming into the US, it would be easier from a logistical standpoint to actually try to physically deliver those contracts. So it was a fear of lack of physical supply. It was short covering that was taking place. But mind you, the bearish fundamentals are still intact for right now. So kind of looking at the technicals, 490 is an area of resistance that we could see. And we would need to have not only just this continued concern about physical supply or logistics, because that's what it is. It's logistics. It's more of like, how do I get it from point A to point B? That's the problem that we have here. And you're going to need to have fundamental catalysts in order to kind of continue to move the contract up. Let me kind of nerd out here real quick. Also, embedded in this article that I wrote, I tried to explain that we are seeing a very significant, and I wouldn't say once in a lifetime, let's say once every cycle type of scenario that is taking place, once every 5 year, 7 year type of scenario, where COMEX, which is the warehouse and the COMEX contracts, which are owned by the CME and all that stuff, right? Their stockpiles are at anemic levels. I'm talking anemic levels. Last time we saw them at this low level was actually in May of last year. And then before that, it was like 7 years, 8 years. But when you're looking at the LME or the London Metals Exchange, their stockpiles actually continue to increase on a week-by-week basis. In fact, or a day-by-day basis. In fact, the last 22 days, 21 of those days, we've seen increases in copper supply, physical stockpiles increasing in their inventory, right? And then when you're looking at Shanghai, they kind of leveled out, but they're still at elevated levels. They're kind of at these levels that we've seen during COVID, which kind of signifies the fact that demand for copper in China is it's there, but it's not as aggressive as what everybody would have hoped. The reason why I bring this up, and then we'll nerd out on some other things here. It's surprising to me, and maybe we do see this coming up, but it's surprising to me that we have not seen a major money player that has the logistical capabilities out there to capture the spread, not only in price, which is around a $300, $400 difference in price between the LME contract and the CME contract, but also capitalize on the warehouse stocks, meaning getting the physical supply from London and then getting that delivered to the US at the COMEX. A major player traditionally would actually take that, would make that trade, right? Those that actually have that power. Now, there's two reasons why I think that might not be the case, or the reason why we are not seeing that. One, maybe the physical market is a lot worse and it's a lot more wrecked than anybody's really like leading to believe, which I think is probably the more likely case right now. Or the arbitrage is not that great yet, even though in my opinion, $300 per contract seems like it's legit enough for me as a trader rather than leaving that on the sidelines. But I wanted to make that note in there because bearish fundamentals, but there's this outlier of physical supply and an arbitrage that's there that has not been capitalized on, and it has been capitalized on over the last 3 months. So there's a reason why, and that actually could provide you price structure or price support at these particular levels, especially what we just saw down at the 430-ish. I think that's where we kind of bounced off of, 429 and some change. So that's kind of the reason why we saw that price action last week. There's some positive supply issues when it comes to Freeport, Indonesia, and the permits that they're going to have. They have a new smelting operation that's up and running. Indonesia is going to allow them to export copper until they get that smelting operation fully up and running, which should actually provide additional supply to the market. So that's the reason why. But everything right now fundamentally says bearish, but that one weird cycle outlier kind of screams, caution for those bears that are trying to short. There's a reason why that ARB has not been corrected yet, and I'm not sure why, but there's a reason why it has not been corrected. So that's kind of the thesis of the small article, if you will.
No, that's awesome. And that banner at the bottom is also the link to the article if you guys want to check it out. I also reshared it on Twitter. But so getting into the next part, which is Sam's chart. So I love Sam, always brings out cool charts, and that's the same thing that Kevin said the other day. He's like, we got to get Sam back on. He's always putting out cool charts, and that's true. This is a really cool chart. Looking at the structure of volume, or technically open interest for copper, seeing it come to those major levels, and this is something that I talk about a lot. which is the fact that there's these very high volume zones, and it's what you have to really pay attention to. Not just the highs, like a lot of people just draw their support on the highs and go, oh, it broke down, that's the end of the trade. And really, like if you talk to old school traders, the thing that they do is take a ruler or a pencil, put it across where the most bars are hitting. And nowadays we have things like volume interest, open interest, volume by price, and so on, open interest by price. And these are indicators that you see on this right side that are these large gray bars. So Sam, what are you seeing on this chart?
Yeah, I thought that was really interesting to see it. It hit that to the T. It happened to line up with the January 2023 peak. So you kind of have some former resistance turning into support as well. So it's a very logical place to see some buying. And then you have what Kevin's saying about some short squeezes taking place. I think copper's setting up to test this this May high again.
Yeah,
I think it could happen fast too.
Yeah, I agree, Sam. It's one, of course, and everybody knows this. I always try to talk about this because I think it's important to understand when you're talking to a trader what their biases are. And right now, like for me, I have systems, so I don't really have biases, but I go with my system. So we're long copper. We have a very long-term trend following system. Obviously, that big pullback is very large. However, it didn't hit our stop and it didn't hit our exit signal just yet. Still trending back up. We wanted to see it get back up and over that 450 level to really get any interest in it again. We're seeing it get back above that level, sustaining up there. So mixing the fundamentals and the technicals together. So what, both of you guys, do you see this hitting the old highs? Do you see this going to that 550 area? What are you guys both seeing?
So, and I got my levels completely off. 435 is what I really meant. I think I said 425, 435. That's a Monday for you. All right. So copper, when you look at a longer time frame charts, this is one of the products that actually does triple top a lot when you're seeing these. So let's just say that we just saw the first peak over the last couple of months, right? And if it continues that trend that we've seen in the past, then you would make that logical conclusion that, yes, maybe we do see it try to retest those peaks once again, maybe even 2 more times before we either see a breakup or a breakdown in action here. Kind of going back, the fundamental case right now says it's a little tough to push it higher. But sometimes you don't need the fundamentals. Sometimes you just need the price action to do what it does, and that's what can actually move prices higher. That's how it works. Especially if you're looking at momentum, hitting that volume shelf, sell buyer stepping in could be something that everybody does a track to or look to for an area of support. So yeah, near term, maybe we do see another retest. A breakout for me would have to also kind of align with the fundamental catalyst. And we just don't have that yet within this space over the last, when I say that, over the last 4 weeks, 5 weeks, right? We had that fundamental catalyst pretty much since October of last year, the short squeeze and the supply situation. But it seems like that's for the most part already been baked in.
But what if we see one of those catalysts being the dollar, the dollar starting to crash? Would you say that could be the thing that kind of helps copper get back up to those levels and possibly break out?
It could. Yeah. I mean, dollar weakness should, in theory, actually provide price support for a lot of commodities that are out there. So that could be the case. I would say the bigger catalyst, though, if anything, it's not so much U.S. industrial production. It's not U.S. manufacturing so much. It's going to be coming out of China. So if you have and when I say hot, when you have rising inflationary data coming out of China, they need inflation right now. They're kind of the opposite of everybody else, where they've been in a deflationary period over the last year, well, pretty much since COVID. So they want to see inflation rising. So if you get decent inflationary prints where we see month over month gains, then I think that's going to be a lot more supportive than a weaker dollar. Or if you see services PMIs or manufacturing PMIs starting to increase the upside, be in expansionary territory, which services PMI is still in expansionary territory. If you look at the print that we got last week, but it was decelerating. So I believe it's more China. It's either China or supply chain rather than dollar. But yeah, dollar, you can make that case. And then it could be rate cuts too. I mean, that was another thesis that a lot of people had last week. I don't know, for me, if that's enough to move copper up like the way that it did. Like, yeah, it could have some tailwinds, but are we saying rate cuts are going to completely just spark a rally or spark this boon in industrial like manufacturing processes in a matter of a month or 2 months? I don't think so. I think it usually takes a little bit longer than that, but that could be the case too.
No, that's a great point, because the markets, the way they work is sometimes it's, and we all know this, I'm just saying it for people out there, sometimes you'll see the price action start to move and you'll have no idea why. And then 2 months later, you'll kind of see a reason. So it's possible you see these rate cuts or something. But once again, it's why we have these conversations. It's, hey, let's figure out what the catalyst could be. Let's figure out what the price action is saying. And then let's try to marry those together and figure out where we're going. So, Sam, what are you thinking? You thinking this is a new rally here, or do you think it's going to stop at the old highs?
Well, I didn't include it in this chart, but the anchored VWAP comes in around just below 470 from this pivot high. So if we can get above 470, I think we're going to those former highs. And I also included the dollar chart, slide 10.
Slide 10, okay.
Yeah. We're getting rejected at the shelf of former highs once again. I think we could see some more dollar weakness here in the short term.
Yeah, I'm kind of there too. It's tough though, right? Because the dollar's been a maniac, a range-bound maniac for a while. So it's one of those ones for me that I'm like, well, if it stays range-bound, I don't know exactly what exactly can happen. But I do think the way the cycle works and the way where we're at in the cycle, I would bet on more downside in the dollar than upside. However, I would be very open if this starts to break, 107, we see a close above 107. I would say, hey, maybe it's time to start thinking that the dollar could move higher here, because that's going to be a major headwind for basically everything across the board. So, Kevin, I also saw a chart on silver here from Sam. So what are you thinking about silver, the precious metal space right now? I find it very interesting where we're kind of at in this part of the cycle.
Yeah. So silver is a industrial metal as well as a precious metal, right? And so you kind of have the exposure, like we talked about, that reflation trade or the industrial side of the economy. Silver is used in 90 to 95% of all electronic components in one way, shape, or form, right? And then it also can be purchased by central banks. It's not as sexy as gold when it comes to central bank buying, but it is an avenue that is out there. We once again a nice little pop last week. I mean, we traded down from to what $2 or $29 and let's say 36 cents. Traded up to $31.46. A nice little rally back, but once again, I think that's a technical buy. Now, if you're looking at the chart, and Sam can tell me something different, you kind of have your elongated cup and handle-ish pattern going on there. All right, maybe. So we tried to break out. It came back, potentially retesting some areas of support, retest that $29 level. Let's say $29 even. Let's say you bounce back off of that and you try to break higher. That can be the case. What's going to get you there? Once again, industrial production and industrial expansion on a global scale can get you there. A weaker dollar can get you there. Inflation risk can get you there. So we have CPI data coming out this Thursday. That might be most likely a nothing burger type of print, but be mindful that we might have some pressures actually for our next print. If the energy side of the equation kind of remains where it's at right now, and if shipping rates stay where they're at right now, I think you could see some pressures, and the pressure would come from those goods, right? The question mark there is going to be the shelter component. It should be breaking soon. And if it does break, then these pressures, a 15% upside move in oil, right, in energy, and a 0.1% downside move for shelter that goes from 0.4% to 0.3% is enough to offset energy. Okay. So for the most part, right? So because it's 30 to 35% of the overall CPI index. So silver can be moved up by the inflationary prints if that were to be the case. Soft landing narrative, maybe, but I don't know. I think the gold and silver for me right now seems like I was looking at 25 from a technical standpoint, not a recommendation, but from a technical standpoint, coming back and trying to test that 25.50 area, that would have been healthy for me, but it seems like it may not want to do that. And if that's the case, then you're looking at $34, $35 to the upside, which is all right. But I think gold and silver can maintain themselves as commodities more than probably any of the other commodities that we generally talk about, just because of the uncertainty that we have with all of these central banks implementing their own style of policy right now. And that uncertainty alone allows it to kind of maintain. And then silver stockpiles, or if you're looking at silver inventory levels and what we could see from SLV buyers that are out there, they could create a pretty significant drawdown or deficit for available silver that's out there. That catalyst can be there. I would have loved to see that 25.50 test back and then try to hit higher. If he doesn't want to get there, then that's fine. If you're looking at it right now, I mean, it looks like it's trying to set up and like it based out for 2 weeks, 3 weeks, and it's trying to truck higher. You want to break above 33 in order to confirm that, though.
Yeah, no, I completely agree. And Sam, where are you thinking this can go? I see you got some targets on here.
Yeah, it's like the best uptrends are really hard to get in, and they don't pull back. This is getting extremely overbought. It's at its most overbought reading since 2020. It's not breaking down below this shelf of former highs. July is the best month of the year on average for silver. I think there's a lot of things working in silver's favor. I'm long silver. I'm looking to sell some at 35. I think over 6 to 12 months, I think we have a chance to get up to 49. I think silver's going higher. I like it a lot.
Yeah, there is a divergence.
Go ahead, Kevin.
I was going to say there is a divergence on the CCI, though, still to the downside. So the CCI is still making lower highs. I would suspect RSI is doing the same thing. For the most part, those indicators are like 85% the same. The only difference is one's tracking a 14-period moving average of price, and the other one's tracking 14 days of price, whatever. But that's the only thing I would just be mindful of. Now, silver traded technically just so well. It was one of the favorite ones because it was kind of like, all right, stochastic bear cross on stochastics, RSI divergence, sell, right? And it would just hit. And then you would see a bottoming in RSI, and then you start to make higher highs on the RSI. You see stochastics, crossing over again, and be like, okay, buy. And that we would literally just trade like that for last 3 years or so. Though the range-bound trade, or not the range-bound, the trending trade now kind of disregards all of those technicals. So like those that have had experience in trading silver, it may be a little bit more difficult. God knows that I know that it's a little bit more difficult to kind of really, I don't want to say call tops and bottoms, but trying to get really used to this new environment of trend and speculators that have kind of gravitated to this product over the last 6 months.
Yeah, and I agree. I think that's something that changes with mindset in traders, like you said, if you get into this trend mindset and everybody's just buying, and then everybody who was a range trader all of a sudden goes, well, I'm going to try to buy the next breakout and so on. Like, it's what you see a lot with undisciplined traders. Not saying like there's a one right way to do it, but I think the best thing that works for everybody as a trader is just figure out what you're good at. I'm a trend guy. I buy trends. I trade trends. I know a lot of people, though, who they're just new to trading and they start and they go, oh, I'm a range trader. Now I'm going to try to buy this breakout. I'm a range trader. I'm going to do this. Just, stick to what you're good at. Trust me, the market is range bound a lot more than it's trending. It's the reason why trend followers like me, we trade so many different products so we can find different trends. So once again, I really like this idea here, Sam, in the chart. I do think that silver could make a major run here. And I see that most of the time what happens in trends is this type of pattern where something in a commodity just goes dead for a very long period of time. And once it makes a new level, really breaks out, kind of has a sustainable breakout, it gets very overbought, stays overbought. Those are the conditions that can lead to a major trend. So once again, I would still think that this has some more upside. So what do you got next, Sam? Let's see what's
I
up
brought
here.
along some of the. Well, this is the seasonality for silver. Like I was saying, July on average is the best month of the year for silver.
Nice.
But I brought along the
92
gold
to
chart as well.
2.4.
If you want to go to the next slide,
Yes.
it's like gold also looks really good. Just a nice tight coil right here below the first extension level of this monster basing pattern. If you can get above 24.5 on the gold, I like gold too.
Yeah, I mean, if you look at gold, that something that I found very interesting was I have a lot of friends in the industry, and I went to a gold store recently, two of them actually, and talking to them about buying gold, like they're just not many buyers yet. People aren't going crazy about it. Yes, it's at all-time highs. It's been sitting at all-time highs for a while, and it keeps making all-time highs, but nobody cares yet. And I was also around during the 2007 to 2011 run. Seeing gold stores back at that point is completely different than it looks today. They didn't even have premiums. Like you could sell gold for spot price. The premiums now are 80 to 90%. You're getting 80 to 90%. So if you have $1,000 worth of gold, you're getting $800 or $900. That's ridiculous. We're just at that point still. So that to me tells me there is no mania. This could go higher. I don't know how much higher, of course, but I think the ingredients are there to see more of a run in gold still. Kevin, what are you thinking about gold? Are the same thing as silver or just a little bit different?
Yeah, so for gold, what we tend to see is breakout moves and then range bound action for like 3 years, 4 years until we have a new cycle of something that occurs. And then we either break down or we kind of move higher. It appears that obviously we had that breakout move to the upside here. It appears that we might be getting at lofty levels for big buyers like central banks. They're still picking it up though. But I would say, we're just finding our new range, and I'm not sure if we're just going to see a complete spike where gold, hits $3,000, 3,200, whatever, and just continues to rally high, like an Nvidia type of move of gold. I don't think that's going to be the case. I don't think you're saying that either, right? But I think just being measured as far as how it trends now. The World Gold Council data that we actually got out last week did see an increase in purchases for gold for central banks again. That we did see a little bit of a break when you're looking at the month of March, where like China was not really buying. Actually, China didn't buy any gold, and I think that was probably just because of the price that it got. But we did see a nice little rebound, 48 tons being purchased in the month of April. So that's a great thing to say the least, right? And so what I would think what happens with gold right now is we might track up a little bit higher. I think we then can stay in a little bit of a consolidation range until we figure out what's going to happen with rate cuts this year. And I hate pinning it on that, but the gold and dollar correlation is probably the most important X maybe oil for the US right now. When it comes to that relationship. So if we see that break in the dollar, that should actually sustain prices or maybe even push prices higher here for gold. But that's kind of what I'm looking at. I mean, the physical market is still buying when you're looking at central banks. And honestly, that's all you care about. If you're going out to Costco and buying an ounce of gold, I'm sorry, I care less about your ounce of gold. It's something that's not going to really truly move. Now, granted, they're doing some damage, right? On a holistic, they're doing damage, but central banks buying it moves markets a little bit more. So if the appetite's still there.
It's what people don't know. It's a huge market, right? Like people don't think about it. It's the same thing when Wall Street's bets were like, we're going to pump up silver, like we're going to show that this whole market's fake. And they were trying to pump up silver and it had a spike and came right back down.
Yeah.
This is a huge market. So it's, for me, I like to take the sentiment at the shops, especially the big ones. but like you said, 1 ounce, 2 ounces, it's just like somebody buying a share of an energy company and thinking they're gonna, destroy the earth by doing it.
Yeah, and nothing. All right, so I actually own physical precious metals, right? What's actually very funny is that usually when you buy precious metals, we're getting completely off topic. Usually when you buy, there's a markup, a pretty significant one, right? No, I mean, if you get a 7% markup on your precious metals, I think that's a win. I bought my gold bar. It had to be like 6 years ago, I just started getting into it. And did I say gold? I meant silver. So silver, I bought that at 17.25 when silver was literally trading at like 13.5 or 13.25, something crazy like that, right? That's how much of the markup is. And like over the last year and a half, I literally just started turning an actual profit on it, because when you go to sell, usually you have a markdown on your sells too, right? 10%, 15%. So I'm not knocking anybody buying physical precious metals at all. I didn't mean it like that. It's just the volume is not enough to really meaningfully push markets. In fact, if you look at it, there's more of an impact of you buying into GLD or you buying into SLV in the aggregation of dollars within those commodity market ETFs that are handling the futures that do have to be backed by some physical, right? There's more of an impact in that market than it is the actual retail buyer of gold and silver, the normal person like yourself and myself. That's the context. I'm not trying to talk down.
No, that makes sense, and it's interesting because I think a lot of people don't know this. Because, for example, if I have a buddy and I'm like, hey, I have a friend at a gold store and they go there to buy gold, they have no idea about premiums at all. Or they go to sell gold and they have no idea that they're most likely not going to get spot price. But if you went back to certain years, that's interesting. The late 2000s, early 2010s, like you had a very different market where everybody was every gold store was looking to buy. They were basically all going at spot price, which was very interesting at the time. And they were selling way over the 7% would be amazing. That'd be the best premium ever. They were selling things that basically, if you had gold at $2,000, you were looking at probably $2,500 to $3,000 of gold. Like that. It was insane at that time. So it's very interesting. Mainly, talking about all of it. One is, here's the caution. Also, I think a good way of doing it. Look online. There's a lot of online sellers that do a little bit better. Look for the big stores too. The big stores in Columbus, we have one called Allen's that will basically give you spot price for gold. That's really good. Very rare, doesn't happen. But look for the big stores because they do that amount of volume, and then you can buy it for just about spot price. And 3 is, if you have friends that are into those markets, there's plenty of people that are happy to sell you their gold for spot price, because if they take it in to sell it, they're going to lose money on it anyway. So there's a couple ideas for people out there to think about the gold market.
And gun shows too, and collectible
and gun shows. Yep, collectible shows. So there's a lot of gold collectible shows, and that you can find really good deals there too. That's a great point.
Real quick, there could be like a mini run on gold leading up to the election. Like I wrote a piece like, man, it had to be like a month ago or 2 months ago, talking about like the latter half of this year, like what could actually and we kind of like, you could smile and laugh about it, but like that is actually probably going to be a thing where like consumer staple companies could actually outperform and see demand move up, because people are like literally stockpiling and hoarding because they don't know what's going to happen with the election. You could have the same thing that for precious metals. I wouldn't put it past it. You actually have the same type of situation in 2020 for spot gold between that November election and obviously what happened with January 6th, right? And all that stuff kind of leading up to that actually did get a significant amount of panic buyers that were out there that were just kind of like unsure. And it sounds crazy. Maybe it doesn't. I mean, I prep. I'm a prepper. I'm all day, right? Mm-hmm. But there's people that actually do take that stuff to heart, and those that feel like they're kind of like behind the 8 ball when some stuff goes down, like they're the ones that usually go out and juice those markets up. So that might be a story that we talk about.
Can you send me that article too, Kevin?
Yeah.
So, but yeah, no, that's interesting because really it's the same thing we saw in 2016. You also saw a big spike right before the election, 2020. So you do see spikes before elections a lot of time. They're mainly tradable spikes. They're not usually sustainable spikes. But this one, if let's say we see a spike and it gets a breakout, because really there's two ways to do this trade right now. We're already long this trade. We bought it a long time ago. However, if you don't have a position, I would wait for it to really get across those levels that Sam marked out here. The one thing I like about Sam's charts, and this is very important for any technician, is when you are trading off the charts, do not use just even numbers. Like Sam does not have 2,500 written on here. On silver, he had $49, not 50. Why would you do that? And the reason is that that's the real number. Talking in the, that's how people talk on TV. It's going to hit $50. It sounds cool. It sounds great. But really how Sam measures the move. And I'll get past that question to you, Sam. So when you're measuring these moves, you're using fibs, you're using, there's measurement methods you can use. What do you like to use to create targets for your trades as a technician?
Fibs are by far my favorite. Definitely. But I also like to measure out the base. Like if the fib extension's not giving you as much, like if it's a smaller base that you're trading and it's only giving you 10%, you can measure out the points in the base and then tack that on to the top of the base. And sometimes that'll give you more. And both methods are pretty effective for sure.
No, I agree, and I mean
you don't have to make it complicated.
Yeah, it's very simple. You measure basically you would take this pattern here, and you can see my mouse on there just barely, but you take that low that we made in 2023, you'd measure to the top, we flag to the side, and then you would take that and you would add that to the next possible move after it breaks out of that next flag pattern, and that could give you your next move, and so on and so on. So there's a lot of different ways to look at that. So up next, we got platinum. We're hitting all the precious metals. I like this.
Yeah. Platinum. If we like gold and silver, we should like platinum and palladium too. They are also in bullish regimes, completing some nice multi-year basing patterns. You got pretty clean risk here against 994 in the platinum. What are you guys thinking about it?
Yeah, I mean we're long platinum right now. It's the same looking at the same thing. So we're long platinum. We had our breakout in platinum that we got that trade, came right back to literally perfection. Literally like the most flat trade I've ever had in years. It literally came back and just like where it broke out is exactly where it stopped out of. So that was just a flat trade. This next move, however, I think that's a hard thing too, and something that some of our subscribers have started to learn and deal with as a trader. So most of my best trades happen when it's my second or third attempt at the same thing. And the reason I think that is because that's what markets make you do, what's hard to do. And it's very hard to just wipe that last trade out of your head and go, I have a signal, and take the next one. You kind of have to be a caveman in a way. I always there was a guy, and why I always call myself the unsophisticated trader is because some guy on Twitter a long time ago, I was posting something about breakouts or trends or something, and he was like, man, you should never even trade. I can't believe someone hired you. You're such an unsophisticated investor. And I was like, yeah, that's true. And it's true, because if you look at it, there is no system, strategy, anything you could build that's right all the time. You can't even find one that's right that actually makes money. Yes, I've shown people this. I've created systems with 90% win rates that lose money over time. If you go to that 40%, 50%, those types of, that's like if you talk to any professional trader, they'll say, I'm right about 50% of the time. So how do you make money? Well, part of it is being able to lose gracefully, lose small. And continue to take that next trade and wipe those losses out of your head. It's kind of like Steph Curry is one of the best shooters of all time, but he shoots at 40%. If he's sitting there trying to take shots and he's worried about the last game where he went 1 for 9 or something, he's never going to take that next shot. So as a trader, I think the thing you have to do is learn to trade small, take small losses, take that next shot, do that over and over again. You will make money. It does happen, but that's the hardest thing to do is lose like that. So Kevin, you got any thoughts on platinum? We can even talk about palladium too in the same breath if you want.
Yeah, so platinum over the last 3 years has been a range bound trade. Let's say 840 area of support, resistance. You're looking at 1132, and it's kind of like trading in that middle level. What is different now, and I'm not sure if we have a true breakout yet, but what's different is that it's testing it's close to the 200-week moving average. It broke above it. We did see it break above that 200-week moving average in December of last year. Only lasted literally like a week and then kind of went below, broke through it again, came back, retested it, but now we're making relatively higher lows. And so that's kind of the first ingredient that you want to see in order to break up higher. If you're looking at RSI, making higher lows, trying to trend higher. MACD, actually bullish. If you're looking at the weekly MACD, which I love looking at, 12 was above the 26 EMA, above the zero line, still trying to move higher. And so I'm not sure. Once again, I mean, it's it's a commodity that's been range bound for so long. It's hard to really extrapolate out what the upside target could be, or even the downside target, what that could look like as well. But it does appear that it is trying to base, and maybe it does stay in this range. And I don't mind range bound markets. So, if it hits 1100, until it breaks that trend of staying above 1100 and staying below 845, maybe you just buy within that trend level until you get that official break out there. But it's trying. Yeah, this is going to be more ICE vehicle driven. That's why we saw a nice little pop last week, right? And so I think that's going to be the real catalyst for this one.
So Kevin also talked about palladium recently, and I thought this was a great thing. By the way, let's give it up to Sam for making my job so much easier. I'm literally just clicking through these things. Sam's doing it. I'm not doing that. So Sam's doing great. It makes my job that much easier. So thanks, Sam.
I mean, you don't like when I just send you random charts in your DMs, like, dude, pull this up real quick.
I don't
nice,
mind
professional.
I don't
nice
mind
professional. Got his deck going, got his arrow lines and everything. We're just like, all right, yeah, here's the chart. Here's some lines on it.
I don't mind it. Like either way it works. But this is just like, wow, this is how Sam does it. Sam also worked for All Star Charts. He's always putting out great stuff. So definitely check them out as well. Sure. But look at Kevin was on Stock Market TV, which is part of All Star Charts recently. So you guys are going to want to check that out as well. But looking at palladium here, Kevin talked about, hey, I think we could have a short squeeze bounce. Looking for this bounce. Bounce absolutely happened, but the bounce hasn't really stopped. Are you still looking at more upside here, possibly to that level that Sam's drawn out, or are you thinking that this is already long in the tooth?
Ooh, man, let me just take my win. Let me take the W and just go to the next one, man. That's a hard one. So he's got that downtrend that is showing there. Yes, it has broken. I would say if you kind of look at that downtrend, the level that I'm looking at on a weekly chart, 50-week moving average is the key area of resistance right now. It has been able to utilize the 20-week moving average as an area of support. Let's see if that's going to hold. They're literally at the apex right now, so much so that the high of today and the low of today, the high of the day is at the 50-week moving average, low of the day is at the 20-week moving average. That's how close it is. So there's no closer apex to a breakout or breakdown type of scenario than what we are seeing right now with this candle. So can we see it pop higher? Maybe. I think the catalyst there is going to be actually earnings for GM, Ford, Tesla, even though it sounds weird for Tesla, but we'll get more insights into the competition with BYD, which BYD also has hybrids, right? And hybrids still use catalytic converters. There's still like a physical demand story there. Supply is literally still fairly, significant when it comes to palladium. Different dynamic when it comes to silver. But let's see. The problem that you have with even like platinum, but the problem that you have with palladium, it needs to have a significant move in order to get speculative retail to be able to squeeze a lot of these guys out. Now, it's a very large contract, but no one's like, oh, what is it? The PAL, PALL is the ETF.
The ETF, yeah.
Yeah. I mean, no one's like, yo, I'm trading PAL today, right? Like until you kind of get that where they're
Hey, Andy's sitting on here, and I know he's trading that.
well,
We
Andy,
got one.
Andy
We got
knows
one.
his stuff. I mean,
Yeah.
Andy knows his stuff though, and he follows us and he knows the stuff that we've been talking about. But yeah, physically, I think it's still fairly hard, but it has been basing. And if it breaks this 50-week moving average, I'm keeping my eye out on that. Then yeah, I mean, you could see a move up to 1840. That's the 200-week moving average to be able to test. That's a tall order. So I what I was referencing last week or 2 weeks ago was that near-term pop, basically. Those things happen. Long-term trends still to the downside though. Sam, what do you think?
Yeah, I like it, and I really like that that short interest built in there, with the hedge funds extremely short, commercials extremely long here. It's been like that for a while, but once this thing gets going, like it could be right now, I think there could be a major move to the upside. It's just like a much more junkier way to play like a gold or a silver. If you're
So palladium's super interesting. So this is
Yeah.
this is something to keep in mind. One is it trades very differently from gold and silver. So we always have to keep that in mind.
Yeah,
But
we like to overlay it with the Nasdaq. Like that
Yeah.
trend has been it's been broken for several years now, but for a decade it traded really closely with the Nasdaq 100.
It really did. So when you go all the way back, what year was that? I can remember having the craziest couple years in palladium. I think that was 2018 to 2020, maybe. I can't remember exactly when it peaked out. But I mean, it was the craziest trend in palladium ever. And I remember that's when I think the palladium ETF came out around that time. It probably came out right at the top because that's how the ETFs always work. But that everybody was interested in palladium all of a sudden, and you've never even heard people talk about this product because it's a very obscure product. You have huge amount of commercial buying this time too, which is absolutely insane. And Andy also beat me to that one in the chat. I just started talking about it, but the commercial buying is huge. It is set up for a huge move. However, you always have to pay attention to these downtrends. When we finally get a trend change, I'd be more interested. However, some of the signals are going to start coming in. They're going to start coming in quick. And then we're going to be long it in the long-term trend model. So once again, I think this could go many different ways. I like that you've drawn this out the way you did. We're seeing a higher low. Most of the time, this is what commodities do. Stocks V-bottom. So you see this huge crash down, and then it starts to move back up. Commodities tend to base just exactly like this. People always try to buy V-bottoms in commodities. And most of the time, they never just V-bottom. They end up going sideways just like this one is. And then it will get a breakout. We'll see a 50-day high. We'll see a 100-day high. We'll see those things start to hit. That might even be a 50-day high at the moment. So once we start to see that 100 high start to hit, now we're starting to get a real trend change. And then the primary trend will change at some point. That's a 52-week high, 200-week moving average, something. But for now, we're still in a primary downtrend. But I am very interested to see where this one goes. Great chart, Sam. So Sam was excited about this one.
Yeah,
I'm excited about this as well. This is the coal index. So Kevin, what do you know about coal? Do you trade? do you trade the stocks? Oh, I do have a couple of the stocks in my retirement.
No, not at all. That is a failing industry here in the United States. Doesn't mean it's a failing commodity though. But in the United States, we are seeing a little bit of a contraction. There's one major player out there that's actually still doing some pretty decent work out there in Pennsylvania. I think it's one of the major hubs for coal. But we did see a nice little spike to the upside. Reason being China. So China has been importing more and more coal and trying to reduce the exposure when it comes to LNG imports. Now they're still importing LNG, but they're also utilizing coal in order to offset some of that cost, because LNG does, for the most part, kind of get a little bit expensive. Coal, when you're looking at it, is relatively cheap on an energy basis, right? And there's still a lot of it that's out there. So we did see some significant buying there. And then also, actually, if you look in India, India is kind of doing the same thing, right? So India is kind of leveraging coal in order to supplement some of the other power generation energy products that are out there as well. So that's another reason why we've seen some sustainable price action to the upside when it comes to coal. That is the extent of what I have. You're not going to hear a book from me, because that's all I know. And I only focus on coal like that is because it's the biggest competitor on an emerging market basis, or even if you want to call China a developing market, right? It's the biggest competitor to liquefied natural gas, or just natural gas in general. So that I only get my coal commentary is only because I'm really focusing on natural gas and seeing how it can actually take away from the price action there.
But it is interesting, and the only thing I really have to add is it is interesting that we have so many people who think that we don't use it at all anymore in the world. And really, there still is a lot of use for it. There's still a lot of utility for it. Yes, we're going to be moving off of it more and more over time, but we are seeing that, and this is quite interesting. It is actually, it looks like it's outperforming most of the oil stocks. Is that true, Sam? It kind of looks
absolutely, like, yeah. These stocks have crushed it.
Yeah, crushed it.
You guys are talking about the thermal coal, which those stocks haven't been as good, but the coking coal is what I'm really interested in, because there's really not much of an alternative at the moment to these blast furnace steel manufacturing plants, things like that require the coking coal. And last Monday, we saw one of the largest coking coal mines in the United States catch on fire, and our equally weighted basket of coal stocks had its best day since late 2020. So I think this could be the start of a next leg higher for this index.
Hey, go on Google. just real quick, go on Google. You guys can all participate. Go on Google and then type in coking coal. I'm on my work computer, by the way. I knew that this would be a little bit of a challenge, but it's a little fun. And then look at like Wikipedia is the first one, Wikipedia, and then just read like the first sentence in Wikipedia. Is kind of funny. No, I'm right there with you. The smelting.
Oh man,
yeah, the smelting operation. I'm in my head. I'm like, yeah, I'm gonna get flagged. At least I had this recorded in order to say, like, look, I wasn't trying to. But yeah, Sam. So you're absolutely right. There's definitely some applications that are out there.
And like AMR, like the bellwether coking coal stock, and this, I don't think there's a single stock out there that's beat it since the bottom in 2020. The stock's up like 20,000%, and like on a relative basis, they have the largest buyback program going, like bigger than Apple's. Like they're buying back a significant percentage of their company each year. I like the AMR.
And I also like the 1 day rate of change that you have on here, because it's very interesting. At the end of major trends and at the beginning of major trends, you kind of see that always happen. You see this major volatility. The buyers and sellers have no idea what to do. They get excited. They get upset. It goes back and forth, and then it just goes stagnant. And then volatility squeezes, and then you have that trend starting. And this is where we started to get interested in it. So once again, glad you brought this chart out. It gives me a little bit more conviction on my insane sounding trade. In my own head, it even sounds insane. But once again, it's not something I use for the fund or the newsletter. It's just something that's personally for myself, not because I love coal. It's just, hey, I'm going to take the trade. I'm not sitting here trying to debate things like that. I'm just trying to take the next trade. So lumber is next. Oh man, and you got a long-term lumber chart. That's cool, because it's hard to find long-term lumber charts anymore, right? You know, they changed the so what I'm bringing that up for is they changed the contract a while ago to the LBR contract. So a lot of the data providers, they broke it into two different parts. Very few of them have it straight up. I think my stock charts one does, and obviously Optima. So And this is a great question. Are you seeing this just kind of bouncing here, being able to sustain this zone? How do you see lumber and rates as well? That's another thing we could talk about.
Yeah, this is a significant level, going back multiple decades. It's been resistance for a long time. We finally broke out several years ago, and it's been a wild ride to say the least. But we've seen this level turn into support multiple times, and I wouldn't be surprised to see it act as support again. Not saying it's gonna scream back higher towards that 1800 level, but I expect this to serve as support.
And Kevin, what are you thinking about the lumber space? Because it's one we haven't gotten to talk about much, and I do like it. I actually do trade this contract, even though it is it's more liquid now that it's LBR. But I'm interested to hear what your thoughts on this as well, Kevin.
I really don't have them. I mean, it's such a trending product that it can disconnect fairly quickly, and nothing against our Canadian cousins to the north of us, but they also have a fair amount of influence when it comes to lumber markets in general. And sometimes price action maybe does not match what we are seeing on the ground. I'm not trying to accuse anybody of anything, but there's a heavy influence when it comes to lumber markets. If I'm looking at it from a housing market standpoint, I think that we're just hitting the peak right now. I think we have a little bit to go to the downside when it comes to the housing market, especially new home builds. And I think that would have a negative impact when it comes to lumber. And so I would say very hard one, but in my opinion, I won't say faded, but I could see it continuing to move to the downside. I understand what Sam's talking about, though. It's really good chart work with the support levels there in that zone, which is what gets me over the top to say we have the economic data says slowings here for housing. What is it? What's going to turn that around in the near term? I don't know. And I think if you kind of look at those past cycles there, all of those peaks were peak housing. And so like we're at like peak housing right now because this existing homes inventory is just not there. So what does that mean as far as prices? So can it continue to go lower if we do see a drop off in purchases? I would suspect that would be the case. But Sam might be right. I don't frequent this market that much, but
the next slide, Jason, is what Kevin's talking about.
Oh, okay. Yeah, so I mean, to me on lumber, it's very connected to rate expectations. So if we're kind of looking at lumber, I do think there's a possibility of it having a nice rally, mainly because of that fact. Disclaimer, very hard to trade product. Even like people talk about natural gas being a widowmaker. I bet lumber is more of a widowmaker over time. And it's not because it's the trends and it's terrible. It's more because the illiquidity turns into, I mean, I have to trade lumber very small. And I've been into limit ups and limit downs and limit everything in this thing. You could get stuck for 4 days in a trade. So you have to size your positions in lumber to be ready for that type of a move, which means you have to trade very small, even smaller than natural gas, very similar to Bitcoin. So next chart, we can end here. I know Kevin's probably got to get going soon, and I got a whole report to run.
Whatever you do. Whatever you guys want.
Oh, you're good? Okay. So ITB, XHB. So Sam, it's your chart. What are you seeing here?
Yeah, both these industry groups are in primary uptrends. This year we've seen them turn sideways, and they're sitting on a shelf of support, potential support. And if the lumber chart digs in here, I think these could also dig in. These have been some of the leaders this bull market. So if they're not digging in here and working their way higher, I think there's something going on with this bull market potentially. This could be a significant red flag in my mind.
Oh, I agree. I mean, most of the time when you're looking at the leaders in a cycle, you really want to take the, let's say there's 5 leading sectors. You really want to look at those 5 and continually monitor, are they breaking down? Are they breaking out? Are they range bound? Right now, this is technically range bound, but we could see that breakdown, and it's very close to it. So if we start to see a breakdown, you might want to pay attention to the S&P 500, see what happens next. Really, if you look at the market right now, tech is still holding up the entire market. That's a scary scenario to be because it's only a few names. So you have to first look at the sectors. As we're seeing the sectors topping out a little bit here, now we want to go to those big names that are really holding up the market and then look at those. And if you look at all of those combined and you go, okay, this is still healthy or this is starting to break down, like you can kind of get a good general direction of what you see in the market. So, Kevin, do you have any thoughts on home builders?
Did the XHB just change their? It seems like the Constitution's a little bit more spread out, because that's the first thing I was going to hate on it, is that it seemed like it was a little bit concentrated, but maybe that was a couple of months ago. So yeah, two different type of ETFs as far as exposure there. ITB is really the actual new home builders themselves. It has a little bit of exposure when it comes to Home Depot. When you're looking at the XHB, that's really the stores or the suppliers of home building equipment and things of that nature, right? So kind of two different areas. I mean, let's call a spade here. Like, who would have thought that they would be performing this way in this type of environment in the first place, right? Like I'm still very shocked that they're even that they've made this type of run. Now, the interest rate market, the fact that we had the fastest interest rate increases I think that we've ever seen, if I'm not mistaken, if not darn near close, and they've had tailwinds because of the fact that existing home markets just haven't been there. I think that changes. And if that changes, that's where you could actually have a divergence, where the Home Depots and Lowe's, I think, can still outperform, right? Because people want to be able to fix up their homes before they actually sell them. So you can kind of see a little bit of tailwind there, and then you're going to have competition when existing homes hit the market. If people are feeling stretched, then the new home builders could actually have some competition when it comes to the market as a whole, when it comes to inventory. So I'm surprised that they're still up here. You want to see a bounce at these particular levels. I don't know, man. I still feel like we pull back on it. There's nothing against what Sam, like, and Sam, you do really great chart work, man. And I want to really acknowledge that, but just understand, like, for me in my head, I have to have, like, I love technicals, and I also have to have that fundamental catalyst to say, yeah, like, this is go time. I don't have that catalyst. I mean, rates being cut, maybe, but I feel like we're going to need a lot more than that in order to try to, justify the valuations that we are seeing. And home builders themselves are trading at pretty lofty levels right now from a valuation standpoint.
I mean, for me, I think of it in a couple different ways. One, this got a little bit ahead of itself, which is very normal in any type of trade. So as this got a little bit ahead of itself, it would pull back, it would consolidate. That would be normal. I would think, though, you want to, like, when you're in these major uptrends, and this is the hardest thing to do as a trader, because it really comes down to, I don't have another word for it besides faith. It comes down to faith in your strategy, your system, whatever, however you want to put that. But you're in an uptrend, you're consolidating. If it starts to move back up, let's say it gives a false breakdown signal here, you want to chase that. You want to continue to chase that. It was very hard for, we had subscribers last year. It was October. It was a nasty, there was a nasty couple months last year. A lot of people forget that because the market went up so quickly, but there was a nasty couple months. We had our ITB trade, long-term portfolio. The stops are very wider than the swing portfolio. And we're hanging on to that trade. And then we also said to start buying more at a certain point when we got into, I think that was November, December. So basically what I'm saying is, most of the time you want to bet in the direction of the underlying primary trend. The primary trend is still up. However, we have to wait for, this is the hardest thing to do, is the confirmation. And I think there's a bunch of ways to do it. There's Kevin's way, which is confirmation by, if next week, and this is what's important with traders, is if next week Kevin sees that hey, these home builders have the fundamental catalyst that I'm looking for, Kevin's going to change his mind and he's going to get long the product. It doesn't matter. And it's the same for me. You know, right now I wouldn't say, hey, I wouldn't buy this thing right now today. But if it did have a false breakdown signal or it breaks out to a new high, I'd say, okay, it is worth buying right now. So there's a bunch of different ways to do it. I think that the idea of a catalyst to trigger your own buying has to change person to person to person for you to have conviction in it to continue to pull the trigger again and again.
I just think the valuations are just too low. I mean, some of those home building stocks,
everything are too high though.
Well, yeah, I mean, some of those home builders themselves, I mean, they pulled back a little bit, but some of them were literally trading at like tech valuations. And
but the market's kind of ridiculous right now. And that's the thing that you and I talked about before is like there are some real scary things about the market at the moment. You know, and that's the thing that's always important to talk about, which is there's risk out there. Yes, most of the time I'm going to be going in the way of the underlying trend, but my fundamental models are in between two regimes, and one of those regimes is very scary for the market. So, and also I looked up the weightings, Kevin, while you were talking about it. That's insane. They have changed this thing completely. HD and lows were number one.
Exactly. That's what I could have swore. Okay, thank you. I'm not going crazy because I could have swore it was HD, Lowe's, Sherwin-Williams were like 15%, 18% of the weighting that's in that. And honestly, I'm gonna be honest with you, some of them stocks I've never even heard of before. So I'm like, all right.
Yeah. So some of the new ones that are, I always trade the ITB as the one we usually use. But XHB, it was always so heavily weighted in HD. And I see that like some of these outperformed, and that's the reason. But they must have also rebalanced too at the same time. So I think we'll end it on this, man. This is a perfect one to end it on. U.S. dollar. And Sam, you could tell me, is there another U.S. dollar chart after this, or is it just this one?
It's just this. I also included the Big Six Bank and JP Morgan. If you just want to show those real fast, kind of interesting. Like we have a multi-decade base breakout happening here in the Big Six Bank Index. And then we have the next chart is JP Morgan, which has made a pretty nasty momentum divergence over the last several months here. We've got the big banks reporting on Friday. I'm going to be paying attention to that. Financials look really good. We've got a lot of financials participating. There's good breadth there. Capital market stocks, a lot of different financials are working. But yeah, back to the dollar. It's a range-bound mess, like we said earlier. We got rejected at the upper bounds once again. I'm looking for a weaker dollar here in the coming days to weeks.
Right. No, and also to speak on the big banks too, and Kevin, you can talk about those as well if you want. So we've been long the XLF, we've been long to large cap banks at the moment, and the big banks have done really well. It's surprising to see how well they've held up in this type of an environment. Fundamentally as well, it's very interesting to see how they've held up in this environment. The regional banks though have not held up nearly as well. So, but once again, it's seeing this market work this way in the large cap spider ETFs and continue to kind of hold on to some of these major levels and to see this one kind of move higher. I'm leaning more bullish than bearish at the moment still. A lot of people are kind of feeling kind of bearish, but I am saying I could agree with either side, honestly. If somebody told me, the market's going to go down here, I wouldn't be against that, or up. I'm just saying for me, my models, my strategy, I'm still leaning more to more upside in this market. And this is also one of those reasons.
Yeah. The larger banks, more diversified portfolios, different revenue streams. They have been able to manage risk very well. They've been able to increase share buybacks, increase dividends. The story is definitely there. We talked about it earlier. The headwind is going to be, what does revenue growth look like moving forward? But I'm not sure if the market's waiting for that yet, right? I think we're still like, let's just kind of get through this, and then we'll worry about growth when we get there. So I'm right there with you. If you're looking at the XLF, be mindful. Berkshire is a huge component of the XLF. It's actually believe, if I'm not mistaken, largest component of the XLF. So maybe they changed that too. I gotta check now. You never know these days. Yes, it's about 13% of the XLF. So be mindful of that. Diversified businesses. I'm curious to hear about the insurance business because premiums have been being pushed to the upside, which is good. It should be a tailwind for them. But when you have events like this going on in the Gulf, are they going to really talk? Are they going to talk about that? I don't think Berkby reports for like another month, though, if I'm not mistaken, like a month and a half. So we got some time there. But yeah, and you know, regionals don't look that bad. People don't love people don't love stocks until they already run, right? And so, like, if you looked at something that was diversified, like a KRE that doesn't have anything more than a 2.5% rating or weighting on a regional, and you kind of look at the chart structure, and you kind of know that the risk right now is CRE risk still there, yeah, for sure. But is it as it as big of a deal or in the front of everybody's mind like it was last year? No. So that could be a surprise. And I think this earnings season, regionals will be a surprise because their comps on a year-over-year basis are going to be fairly easy to beat. So they should be able to surprise to the upside regionals. That should also then lead credence to the big banks, right? And then, you know, utilities. I think utilities are going to have a pretty decent earnings season as well. So I like this chart. I like the thesis there. It's just trying. Hopefully it doesn't fail.
Yeah, I mean, I also like the KRE as well. Is quite interesting, and something that's people should keep in mind is that its top holding is actually down 69% for the year, or in a year to date down 66%. So I mean, that's weighing on that one pretty heavily. So once again, I think the KRE could start to make a move. It is holding up nicely, considering everything that's been thrown at it, not to mention the environment, not to mention rates, not to mention oil. You know, there a lot of those companies invest in oil producers and so on. So as all of these things are kind of hitting it, it's holding up decently. So that's one to keep on watch from Kevin as well. So going back to end it on the dollar, which is the macro traders dream. Everybody's looking at it. Everybody's trying to think about it, where it's going, what it could do. We talked about a little bit earlier being stuck in this range. And so I guess we can end on what do we think with rates, the dollar, and where everything's heading. So we'll start with Sam, Kevin, and then I'll just end us off with whatever.
Yeah, I think they're range bound. They're all range bound. Rates, I think, could be going lower here. Bonds have been digging in, making higher highs, higher lows. It's a process. It's a huge asset class, but I think bonds could be working their way higher here.
Yeah, I mean, we see the writing on the wall, what's happening, what's going to happen eventually, right? And so I think that does weaken the dollar from here. And then I also believe that a lot of these because when you're looking at the dollar, you're comparing it to another currency. So if you're looking at the Eurozone or if you're looking at Great Britain, like a lot of these countries or a lot of these areas have already experienced the recession. So they cut earlier than us, then they should see some tailwinds when it comes to their economies, which should strengthen their currencies and weaken ours. So I'm right there with Sam on that. I think it breaks down.
Yeah, I mean, I guess we're all on the same page here, which is cool. That's very rare, which I like about.
We need to disagree more.
Yeah. We usually do. There are plenty of disagreements, but I think the good thing about what we do is that when it makes sense, it just makes sense. You know, like I said earlier, I'd be very open to this move to the upside, but looking at rates, you know, where we're at, they're going to have to do some work on the long end of the curve to make this make a little bit more sense too. So I'm kind of still leaning on the fact that they are, like Kevin said, the writing's on the wall. They're going to lower rates at some point. Does it happen in September? I'm not sure. Does it happen by year end? Most likely. Maybe December or maybe the beginning of 2025. Either way, the one thing we know is that they are going to start cutting at some point. What's that going to do to the dollar? That's the next question. Now, once again, you basically, the way you have to look at currencies is by taking all these different countries. You could take their GDP growth, and then you also take their central banks. You put that all together, and you can kind of come up with a template of how these things could move and where they could be trading. I'm still seeing that there might be some pressure from the Eurozone, meaning the euro would get a little bit weaker, which could also help bring some more dollar strength. But I still would think that this has downside, but I still would go, okay, if it really breaks above that level that Sam has marked out there at 105, I would still think it could possibly move higher. And I just wouldn't bet against it if it breaks out. And I would keep thinking that it could go lower for now until it really breaks out. So, all right, guys. So I think we'll end it there. Thanks so much for coming on. I think this was a great, Kevin's talked about it a few times before, which is, we should have like just a session where we just go through a ton of stuff all at once. And I think we did that today, and that was fun. Yeah. Thanks for coming on, Sam. Great.
Yeah, appreciate you, Sam.
And fun stuff to talk
Thanks
about.
for having me.
Yeah, it's always fun stuff when you come on here and we're able to kind of chat through the charts, because really, like, your view on it is untainted. As you trade for a long time, sometimes views get tainted. You mark charts out certain ways, you do certain things wrong, but you look at the markets in a very simple, technical way, which honestly is the best way. Like, looking at things very simplistic is a very good thing to do, because trading is as complicated or as simple as you make it, really. So I appreciate you coming on here, bringing these beautiful charts, giving us some great ideas, and I hope everybody had a lot of fun on here as well. So, all right, guys, we're going to let you go. Make sure to follow Sam. Sam, where can people reach you?
My Twitter is Sam_Gatlin. You can check me out on the All-Star Charts blog too. Just wrote a deep dive on coal stocks on Friday. Be sure to check that out. It was a good one.
You're killing it, Sam. Good work, man. Looking forward to having you back on and keep going through these charts. So
thanks, Kevin.
Really good work, man.
Yeah, and Kevin, you guys know where to follow Kevin, KG Bull and Bear on Twitter. This is his last article. If you guys just go to his page at KG Bull and Bear, you guys can see all of his work. Kevin's putting out great articles every week. He comes on here once a week. We do the commodity report together. And you guys can follow me on Substack as well. And Kevin, do you have anything else you want to add where people can find you?
You can find me on X. I'm on LinkedIn too. I'm not as active there, but I'll still like post a couple of articles. I don't know what my LinkedIn, just look up Kevin Green, Schwab Network, and you can find me there. I don't know what my username there is, but yeah. Mainly here though, this is where we do the real deep dives. So, it's always a great opportunity and always getting really good feedback around this. And so, I appreciate you continuing to host these things. I think it provides us a lot of value, and just going real quick, what you were kind of talking about with Sam, you have an untainted view, and then you come on and then you say, hey, and then you'll hear my tainted view and my jaded view. And sometimes I even have to sit back and say, man, that chart does look good though. Like,
and you do.
I think, sometimes it's nice to get another set of eyes, and we can kind of level set. And then those that are actually watching this, they can kind of balance everything out and say, okay, this is what I can take from every individual, and they make their mind up as to what to think about a certain product. So I really do appreciate it.
And it's the same for me with Sam, and even this chart, the dollar chart, just looking at it, my brain, because the dollar has smacked me so many times in the last few years, my brain, even though I have systems and signals, my brain's still telling me like, hey, this could move up higher. But this chart also helps me to go, no, just follow your systems, dumbass. Just keep doing the same thing, So appreciate you coming on, Sam. You're always welcome on here anytime you want to come on. And we're on every week at 11 a.m. On Mondays. So 11 a.m. Eastern time on Mondays. Please come. Please ask questions. I know everybody's on Twitter, but please come to YouTube. We need more people on there, and then you guys can chat with us. All right, guys. Take it easy.